In 2008, Michael Burry saw the crash before anyone else. He placed his bets, took massive losses at first, and nearly everyone thought he was wrong, until he wasn't. Fast forward to today, and he's making another huge move. He's dumping stocks, shifting his money into places no one expected, and signaling that something big is coming. The real question is Burry about to be right again, or is he making another call too early? His latest 13F filing shows that he sold over $32 million worth of stocks and bought $36 million in new positions. But here's what doesn't make sense. He's selling his stakes in Chinese giants like Alibaba and JD.com, yet he's increasing his position in Pinduoduo, a company in the same niche of business. He's trimming healthcare stocks, yet making one of his biggest new bets on HCA Healthcare. And at a time when most investors are looking for safety, he's going against the grain by putting millions into Estee Lauder, a high-end luxury cosmetics brand. Something about this portfolio shift doesn't add up. So what is it? What is Burry's strategy? Is this the start of something bigger? And most importantly, should you be paying attention? In this video, I'll break down every stock Michael Burry just sold and bought, what it means and why it matters. I'll break down the $32 million in stocks he dumped, the $36 million he reinvested, and what this shift says about the market. Is he predicting a crash or just repositioning for a new cycle? Let's break it down. First, let's take a look at what he just sold and why he's getting out before it's too late. Michael Burry rarely sells off stocks without a good reason. In this latest filing, he unloaded over $32 million worth of stocks, with some positions being completely wiped out. He sold every single share of Shift 4 Payments, Olaplex, and RealReal. Shift 4 Payments 4 was his largest exit, selling off $10 to $14 million worth of stock. This company, which operates payment processing services, has been riding the wave of digital transactions. However, the fintech space is becoming more competitive, and regulatory pressure is increasing. Maybe Burry saw warning signs that others were ignoring. The stock has been volatile, and if the economy slows down, businesses cutting back on spending could hit companies like Shift4 hard. Olaplex OLPX was another full exit, worth $1.4 million. This one is interesting. Olaplex is in the beauty sector, a space that traditionally does well even in downturns. But the company has struggled with revenue declines and legal battles over product safety. It's possible that Burry saw this as an unnecessary risk and decided to take the loss before things got worse. RealReal, R-E-A-L, is another one he abandoned entirely, selling off $3.5 million. This company specializes in secondhand luxury goods, a market that saw massive growth during the pandemic. But as inflation squeezes consumer spending, luxury resale may not be as resilient as people once thought. If buyers start pulling back, businesses like RealReal could see their margins shrink fast. Beyond the complete exits, Burry also made some major reductions in stocks he used to be heavily invested in. Alibaba, BABA, and JD.com, JD, both got slashed, down 25% and 40% respectively. This is a big shift considering how much exposure Burry had to Chinese tech, also considering he bought in Q3. China's economy has been facing uncertainty, with government crackdowns, slowing growth, and increasing risks of geopolitical tension. But here's the twist. Burry didn't cut all his Chinese holdings. He actually increased his stake in Pinduoduo. So what does he see there that he doesn't in Alibaba or JD.com? This could be because Alibaba's price shot up last year, and Burry wanted to secure a portion of profit and the rest invested. Another surprising move? Molina Healthcare, MOH, which was reduced by 16.67%. At first, this seems odd, given that he increased his investments in other healthcare stocks. More on that later. But Molina is focused on government-sponsored health plans like Medicaid and Medicare. If Burry sees policy changes or budget cuts coming, that could explain why he's pulling back. There's a clear theme here. Burry is moving away from high-risk tech and speculative growth plays and reducing exposure to companies that rely on discretionary spending. That could be a sign that he's expecting economic uncertainty ahead, and he doesn't want to be holding stocks that are vulnerable in a downturn. But here's where things get really interesting. He isn't just selling stocks, he's actively reallocating that money into new positions. And the companies he's betting on might give us a clue about where he thinks the economy is headed next. Let's take a look at what Michael Burry just bought and why he's putting over $36 million into these stocks. One of his biggest new positions? Estee Lauder, where he invested around $7.5 million. A luxury cosmetics company might seem like an odd choice, especially when many consumers are cutting back on discretionary spending. But historically, high-end beauty brands tend to hold up well during economic downturns. It's called the lipstick effect. When people can't afford big luxuries, they still indulge in smaller, feel-good purchases. Burry might see Estee Lauder as a defensive play in a slowing economy. Then there's Pinduoduo, PDD, where he invested around another $7 million. This is where things get really interesting. While Burry cut his stakes in Alibaba and JD.com, he actually increased his position in Pinduoduo. Why? One theory is that Pinduoduo operates differently from the other Chinese e-commerce giants. It focuses on low-cost group buying and has been expanding aggressively into international markets. If Chinese consumers tighten their wallets, Pinduoduo could benefit by offering cheaper alternatives compared to Alibaba or JD. HCA Healthcare, HCA, is another big buy, with Burry putting in $4.5 million. This one makes a lot of sense. Healthcare is a defensive sector. People need medical care regardless of what's happening in the economy. HCA operates hospitals and healthcare facilities across the U.S., making it a stable business even if economic conditions worsen. But you might question, he just sold MOH, another stock from the healthcare industry. The difference, as I said, is that MOH depends on government-sponsored and HCA does not. It's clear that Burry is shifting a portion of his portfolio into industries that are more recession-proof. Then we have Oscar Health, OSCR, Bruker Corp, BRKR, and VF Corp, VFC. These aren't as massive as his Estee Lauder or Pinduoduo positions, but they still signal something important. Oscar Health is an insurance tech company, Bruker Corp is in the life sciences and diagnostics space, and VF Corp owns well-known apparel brands like Vans, The North Face, and Timberland. Burry is picking stocks in industries that people can't completely cut out of their lives, even during tough times. Another surprising addition? Magnera Corp, MAGN, which operates in the materials sector, and American Coastal Insurance, ACIC, which is focused on property insurance. Materials companies often benefit from infrastructure spending, and insurance tends to remain stable even in downturns. So, what's the bigger picture here? The trend is clear. Burry is shifting away from speculative tech and growth stocks and moving into defensive sectors like healthcare, consumer staples, and insurance. The important word here is moving away from speculative. He's not completely abandoning risk, but he's being much more selective about where he's putting his money. Let's start with what he's moving away from. The fact that he cut his positions in Alibaba and JD.com while keeping Pinduoduo tells us something. He's not necessarily bearish on China as a whole, but he is losing confidence in the larger, more traditional e-commerce giants and also securing gains. There are regulatory risks, slower consumer spending, or competitive threats that make Alibaba and JD.com weaker bets. But Pinduoduo, with its unique group buying model and lower cost offerings, might be better positioned for a tougher economic climate. Then there's Shift4 Payments, Olaplex, and RealReal. These were full exits, meaning Burry didn't just reduce his exposure, he got out completely. Fintech, beauty, and luxury resale may have been great plays during the bull market, but they're also sectors that could get hit hard in a downturn. If consumers start cutting back, spending on these kinds of businesses could slow down fast. Now, let's talk about where he's moving his money. The biggest signal here is his shift toward defensive sectors. Healthcare now makes up over 24% of its portfolio, with stocks like HCA Healthcare, Molina Healthcare, which, though reduced, still has some position, and Oscar Health. Healthcare stocks tend to perform well in uncertain markets because people still need medical care no matter what happens in the economy. Then there's Estee Lauder. It might seem like a strange pick, but this actually fits the same theme. When times get tough, people still buy small luxuries. A high-end beauty brand like Estee Lauder could be a recession-resistant play, especially if other discretionary spending slows down. And unlike Olaplex, which is losing revenue, Estee Lauder has managed to maintain its yearly revenue. So, what does this tell us? It looks like Burry is bracing for economic uncertainty. He's moving away from riskier sectors, cutting exposure to speculative tech, and loading up on stocks that tend to hold up in bear markets. But is he predicting an outright crash? Or is this just a shift in market leadership from high-growth stocks to more stable income-generating companies? To answer that, the first big takeaway: Burry is prioritizing stability over speculation. If you look at the stocks he's selling, they're mostly companies that rely on strong consumer spending, fast growth, or market optimism. On the other hand, the stocks he's buying, healthcare, insurance, and consumer staples, are sectors that people rely on no matter what the economy is doing. This could mean he expects a slowdown, rising inflation, or some kind of market turbulence that makes safer investments more attractive. This shift isn't happening in a vacuum. The stock market has been running hot, but at the same time, we're seeing signs of unstable interest rates, rising debt, and consumer spending fatigue. If the economy weakens, the high-flying growth stocks of the last few years could struggle, while defensive industries like healthcare and insurance could outperform. So the question is, should everyday investors follow Burry's lead? The answer isn't that simple. Burry is known for being early, sometimes years early. He called the 2008 crash, but his bet against the housing market looked like a disaster before it finally paid off. He also shorted the stock market in 2021, expecting a major crash only to reverse course when markets stayed resilient. So just because he's shifting toward defensive stocks now doesn't mean the market is about to collapse tomorrow. But there's still something important here. The market has had an incredible run, but it doesn't go up forever. At some point, there will be a shift. And when that happens, the companies that have been thriving in a booming economy may not be the same ones that perform well in a downturn. This doesn't mean you should go sell all your stocks and hide in cash. But it does mean that now is a good time to evaluate your portfolio. Are you overly exposed to high-growth, high-risk stocks? Do you have enough stable investments that can hold up if things get rocky? These are the kinds of questions Burry's moves should make every investor think about. Jeremy Grantham thinks there is a cataclysmic decline ahead. Click the video on screen to find out.